What would you do if you had a lump sum of money? Invest it all at once or spread it out over time? This is one of the most debated topics in investing. And today, we're diving into the numbers, the scenarios, and the psychology behind lump sum investing versus dollar cost averaging. By the end of this video, you'll know exactly which approach will work best for you. Okay, let's get started. Hi, I'm Kevin Elliott, and welcome back to the channel. If you're new here, I help educate and empower people to make smart financial decisions, enabling them to build and preserve true wealth. Okay, in today's video, we are tackling one of the most common investing dilemmas, investing in a lump sum versus dollar cost averaging, or DCA for short. I'll break this down into what each strategy is, the pros and cons of each strategy, real life scenarios to help you decide, and finally, how to choose the best strategy for you. So if that sounds good, make sure to hit the like button and subscribe for more personal finance insights. Okay, let's dive in. First, let's define the two strategies. Lump sum investing is essentially investing all your money at once. Imagine you receive a €100,000 windfall and immediately invest it all in a globally diversified portfolio. You're diving straight into the market. Whereas dollar cost averaging, it is about spreading your investments over a set period of time, say 12 or 24 months. Instead of investing that 100,000 all at once, you may invest 8,333 evenly over 12 months. The goal of lump sum investing is to maximize your growth by giving your money the most time to compound. Whereas with DCA, it's about reducing risk by avoiding bad market timing. Both strategies have their place, and choosing the right one depends on your timeline, your risk tolerance, and your emotional comfort with volatility or risk. The case for lump sum investing. Now let's look at lump sum investing. Research, including a Vanguard study, shows that historically lump sum investing outperforms DCA about 68% of time. Why? Because markets generally trend upwards over the long run. Over the last 30 years, for example, the MSCI World Index has returned an average of about 8% annually. Here's a detailed example. Imagine you invest €100,000 at the start of 2013 in a global diversified equity fund. By 2023, assuming an average annual rate of 8%, your portfolio would have grown to approximately $215,892. But if you spread that $100,000 over 12 months, investing $8,333 each month, some of that money would miss out on the early growth. By the end of 2023, your portfolio might be closer to $200,000. That is about a €15,000 difference. By investing everything up front, you're giving your money the maximum amount of time to grow and compound. It's like planting all your seeds on day one instead of spreading them out over months. The risk of lump sum investing. But lump sum investing isn't without its risks. What if the market crashes just right after you've invested? Here's a worst case scenario. Imagine you invested €100,000 in the S&P 500 in October 2007, right before the financial crisis. By March 2009, your portfolio would have dropped about €50,000. Yes, that is a 50% loss. This is the psychological hurdle of lump sum investing. The fear of losing a large sum of money overnight can be paralyzing, and that's where dollar cost averaging comes in. The case for dollar cost averaging. Dollar cost averaging is designed to reduce the impact of market volatility, and here's how it works. Let's say you invest $8,333 monthly over 12 months instead of investing the $100,000 at once. If the market drops during that period, you're buying more shares at a lower price, so essentially you're getting a discount on your investments. Now, imagine that the market dropped by 20% in month 3. When you invest your $8,333 that month, you're buying assets at a significant discount. Over time, this can help smooth out the market volatility. DCA also reduces the emotional stress of market timing. Instead of worrying about finding the perfect moment to invest, you're taking a disciplined and consistent approach. It's a strategy that builds confidence, especially for new investors. The downside of dollar cost averaging. But DCA has a major drawback, and that is the opportunity cost. While you're waiting to invest, a portion of your money is essentially sitting on the sideline, potentially missing out on big gains. In our scenario where you have €100,000 to invest and the market rises 10% in the first 6 months, and half of your money is sitting waiting to be invested, you've effectively lost €5,000 in growth. The amount invested grows to $55,000. However, if the full $100,000 was invested, it would have grown to $110,000. making the difference in your potential gains of 5,000. That is a trade-off between reducing risk and maximizing returns. A real-life scenario. Let's put this into context for two friends, Sarah and John, who each had €100,000 to invest in S&P 500 starting in 2015. John was more gung-ho and invested his full 100,000 on January 2nd, 2015, when the S&P was around 2,058. Sarah, on the other hand, used dollar cost averaging, investing her €100,000 evenly over the 12 months. Fast forwarding to 2025, when the S&P is around 6,100. John's investments grew to 297,158, whereas Sarah's grew to 297,000. Okay, so there's a difference of €158. It's minuscule, but it proves the point. In a rising market, lump sum investing tends to outperform DCA as it maximizes potential growth, whereas DCA reduces risk but can lead to lower overall returns. If you're sitting on cash, waiting for the perfect time to invest, history suggests that time in the market beats time in the market. Behavioral factors. Investing isn't just about numbers, it's about emotion. If watching your portfolio drop about 20% causes you to panic and sell, lump sum investing may not be for you. In contrast, DCA helps you build confidence by spreading out your risk over time. Remember, behavioral finance plays a huge role in investing success. As Benjamin Graham said, in the end, how your investment behaves is much less important than how you behave. If emotions drive your decisions, a steady, constant approach like DCA may keep you on track. Best strategy for you. So what is the best choice for you? If you're confident in the market's long-term growth and can handle short-term volatility, lump sum is likely the better option for you. But if you're more risk-averse or uncertain about timing, dollar cost averaging offers a safer, more gradual approach. Or you could consider a hybrid, which would be investing 70% up front and then doing dollar cost averaging with the remaining 30% over time. So for example, invest 70,000 immediately and then spread the remaining 30 over the next 12 months. This way, you can capture early market growth while reducing the emotional stress. The most important takeaway, start investing. The biggest risk is doing nothing while inflation erodes your wealth. Do you have a question about your investment strategy? Drop them in the comments below. And don't forget to like, share, and subscribe for more tips on building your wealth. Thank you for watching, and I'll see you in the next video.